My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our GFM clients and guests who are joining us for this morning's webinar, where we're going to talk about our preferred private assets investment, the Ellerston JAADE Private Assets Fund. We're absolutely thrilled to have David Leslie, who is the co-portfolio manager of Ellerston JAADE Private Assets Fund, and Tony Corsanos, who is the investment director of JAADE, joining us this morning. I'll officially introduce David and Tony in a moment. As incredible as it seems, we're now nearing the end of 2020, particularly for our clients based in Melbourne, and we're a Melbourne-based firm. It's been a long year and we've spent a majority of the year in lockdown. In lieu of being able to run our usual face-to-face events and to be able to see clients face-to-face, back in April, we started a series of webinars on behalf of our clients for the remainder of 2020, and these webinars have proven very popular. We ran the webinars for two reasons. We wanted to keep in touch with our clients, and we also wanted clients to remain abreast of what our feelings and thoughts were of investment markets. We've been absolutely thrilled with the attendance rate and the feedback that we've had with these webinars. But looking forward into 2021, as things have now dramatically improved in Melbourne and around Australia, and let's hope it remains that way, it's highly possible into 2021 we'll be able to resume our normal face-to-face activity with clients, that is during our normal client meetings and hopefully with some client events. An area of investment markets that we find particularly fascinating and looking forward into 2021, an area that we think will be a real focus for our portfolio construction, is in the area of private assets. Many of the clients who have joined us on this morning's webinar are investors in the Ellerston JAADE Private Assets Fund, but we also have a lot of clients and guests who are joining us this morning who are not investors. Now, it's important to note that today's seminar is information which is general in nature. We are a big supporter of the Ellerston JAADE Private Assets Fund. We're a big believer in private assets being a part of our clients' portfolio construction. But today's advice is general. It's general in nature. It's not specific to your circumstances. So that we ask if you are considering or wanting more information on the strategy or private asset investing, you get in touch with our office and one of our advisors can assist you to discuss whether this is suitable to you. And you can see the disclaimer on the screen. So let me formally introduce David and Tony. David joined Ellerston Capital in 2005 and has over 23 years experience in technology investment markets as a researcher, analyst and investor. Most recently, David has been the investment director of the Ellerston Ventures Fund and the Ellerston JAADE Private Assets Fund. In this role, David leads the investment process, due diligence and negotiations with the investees, as well as reporting to the investors. And Tony has over 20 years experience in senior executive work in financial and general management, strategy, mergers, acquisitions, communications, technology and risk management. Tony is currently an investment director within JAADE, and she also serves on various ASX 200 boards across a diverse range of companies ranging from Treasury Wines and Webjet. So welcome, David.
Thanks, Paul.
And welcome, Tony.
Hi, Paul.
Tony, look, I'll start with you first, if you don't mind. I think what we'd love to start with is really an explanation to our clients and guests. What is private asset investing and why did you set up the Ellerston JAADE Private Assets Fund?
Thank you, Paul. I'll talk to some of the differences in private assets and public assets, but I think from my perspective, private assets are, they do provide a good opportunity to diversify an investment portfolio. They're not well represented in markets. They are under the radar more often than not. They're hard to access, hard to diligence. It's not like when you're looking at a public asset and public stocks. They're often held tightly by founders. And if I consider the portfolio that JAADE has, that's the case in most of the investments we've made, where we've been the first large injection of funds into those assets. Assessment, how we assess our investment varies across a public asset and a private asset. it's not just a quantitative assessment. It is getting to know the founders very well and understanding what generally tends to be either a new product or a new commercial model or a new market. What you find is that you can take control of the investment outcome more so than you can in a public asset, and that's because public markets can be quite irrational, more volatile. And often you're dealing with activist shareholders as well, so you can contain your situation, but you do also rely on, they're less mature businesses, but they're also very entrepreneurial. So I think that the bottom line is, and also one of the things that I've learned a lot through my engagement with JAADE and getting involved in private assets is, I still get blown away by the growth that a lot of these assets are positioned to achieve. And it's never a given, right? There is always effort to achieve that growth, but the potential is there. And that's the difference versus mature assets and public assets that are in established markets. A lot of these assets are private assets are in markets where they're actually growing the market, right? So the potential is very different. In terms of my involvement with JAADE, it was a little bit selfish, I should say, from the perspective of we all look to diversify our investments, the ability to go and seeing a few very, very high potential private companies and taking positions in those as an individual. First of all, it's hard to find them, diligence them, get comfortable alone, and then just do single point investments on your own. Doing it through a fund really helps. So you get diversification in diversification. And I think at JAADE we've done very well in the combination of assets we've got. We've seen a net improvement in valuation over the time that we've established the fund, and that's the benefit you get from being an investor in JAADE. And that's, I like the idea of establishing a fund that I could also invest in, and we've all jumped in and invested, obviously. But it also gives me the best of both worlds. I like my exposure to listed companies, but working with these smaller private assets is more intimate. You get more involved. It's not as heavy on governance as it is on strategy, right? And I like that. I like the ability to build businesses and lean in, mentor and work on building out new teams and driving new strategies and growth. And in most of the cases, in terms of the ones we're looking at, it's not just growth within Australia, it's growth offshore. So while it's, as I said, it's a little bit selfish, but I enjoy it, and it gives me more exposure and more and a better work-life balance in terms of the way my portfolio shapes out and how I engage in business, both public and private.
Oh, fantastic, Tony. So David, Tony's alluded to the growth opportunity potentially of investing in private equity or private assets, but I'm keen for you to sort of give a further explanation of why you think private assets or private equity is worth including in a diversified portfolio.
Yeah, thanks, Paul. So there's definitely the growth aspect. So when we're looking at private companies, so if you take the ASX, if you're a company trading at that's achieving more than 20% EPS growth, you're trading on phenomenally high PEs, 2 times sort of market averages. People pay, in an ASX listed context, the premium paid for growth is extraordinarily high. What we can do with private companies is, whilst they might not always be profitable, we're focusing on businesses with good economics, good unit economics, and clear plans to profitability. But we're investing in businesses that are growing at least 20 or 30%. And in fact, if you look at our portfolio companies, you've got 80% to 100% growth from some of our portfolio businesses. So typically they're much more focused, as private businesses, they're much more focused on growing in these emerging markets with these large new business opportunities where they're taking share from traditional and disrupting traditional businesses. So whether you're in healthcare, education, travel, the technology players that we're looking to invest in have got much higher growth rates than the mature players that are listed in the market. The other part that comes with that, whilst they're focused on very high growth rates, you're also able to get very good valuation terms because they're private companies. So you're not paying listed company multiples. So there's an inherent discount in that illiquidity that you have in investing in private companies. And the fact that you can't sell your shares in an unlisted company any day of the week, we typically negotiate that into some 30 to 50% discount for what might be an equivalent listed company. So we think we get the best of both worlds. We get emerging themes, technology businesses that are disrupting sectors. We get it at growth rates that are far superior to what you can typically find in listed companies, but you're also getting it at a discount. It doesn't mean that the risks aren't high in private assets, but there is a lot of the rewards and the opportunities for growth are definitely there.
Thanks, David. Tony, I'm curious. So there's these opportunity of investing in these businesses, these private assets, but what are you looking for in these companies? What are the criteria for investing?
Well, essentially, we're looking at businesses that have got an established, well, where we invest in terms of the maturity of businesses is they've got a proven product. We can see there's a growing market. They've got proven commercial models, and they're already generating revenue. And then for us, it's where can we lean in? What is the value we bring to the table? So you could always, run the financial assessment across these companies, and they look great. But for us, there has to be what value do we provide? And because we don't take a control position, so there has to be more value that we add to the table. The investee company has to see that so that we know that we're going to get the right engagement without holding a control position of the asset. We look for recurring revenue commercial models. We don't, and in the main subscription, transactional revenue is good, but subscription revenue is even better. And essentially it's the fit is very important. The engagement with the founders, in most cases it is with founders, is very important. So we start with a quantitative viewpoint, but the real decision at the end is heavily based on our qualitative assessment and our engagement with these businesses.
David, one of the things that fascinates me is when we're looking at public or listed markets, we've got great visuality of what's happening in the market, but I don't know how the market has been this year for private assets. So what's your observation of the private asset markets, let's say during 2020?
Yeah, 2020, a year like no other, and let's hope it doesn't happen again. So at the beginning of the year, we had, we were a year into the fund. We had a couple of assets that were performing really well, and we had a good pipeline. And it felt like at the beginning of the year, we were very much, carving out some new territory as a growth investor in Australia. Well, from about March onwards, the world changed, and whether you were in Australia or in the US, if you're a private asset investor, your number one priority was making sure that your companies were in good shape, good fiscal condition. There was a lot of difficult decisions that had to be made to protect the businesses, whether it was furloughing staff, taking advantage of government funding and whatnot. But as an investor, there was no easy new investment decisions that you could possibly make. So, we came into to the COVID period, and our immediate priority, like every private investor, was to make sure your companies, your portfolio businesses were going to be okay. So before we could write a check on a new investment, we had to make sure that they weren't going to fall over because their business models were so terribly disrupted. So as we've emerged out of that, I can't tell you the volume of activity that we've seen as we've gone into this final quarter of the year has escalated phenomenally. So we began, being in Sydney, we began getting back into the office towards the middle of the year. We began really engaging with companies that we might have known in the past to sort of see if their temperature had changed in terms of their desire for investment. And we started to really work with businesses through that September quarter. And it felt like in that sort of September quarter, there was a raft of activity at a very nascent stage that began. What that's turned into, as we can see through public markets, but also in private sense, is a lot of activity. So, there's the IPO market showing that the capital markets are open for doing business, but in a private sense, we're seeing a larger number of deals than what we've seen in the past, but also the quality of the deals that are coming out. So bigger companies that might normally have been a little bit reluctant to necessarily think they need capital have probably got a more conservative lens on the world at the moment and are being a bit more prudent about their capital requirements. And in many cases, founders are also looking at overall market conditions and saying this is not a bad time to have some sort of a realization event or bring in a capital partner. So, Paul, it's been I don't know that we can extrapolate this year into what might happen next year, but I certainly hope not in just about every respect. But you know, we've certainly seen an escalation in the activity. We've been building out our team. We've completed one investment this quarter, and we've got some other deals that hopefully we can bring to fruition before too long.
Okay, so David, you've spoken about the deal flow at the moment, both the quality and the quantity being there.
Yeah.
You know, and perhaps it's a question for you too, Tony, but is this pent-up demand, or do you think COVID's actually changed the environment or the demand for private asset investing?
I think the demand for private asset investing has gone up because if you just look at the volume of capital that people have to deploy and that are looking for better returns, you know, you'll form a better view than me, Paul, on the listed market returns. But there's definitely an element of people looking elsewhere for these sort of growth rates, the value discounts. What we're seeing is in the Australian context. So if you think about private markets from a traditional sense, you've got management buyouts, so your leveraged buyout firms, you know, your KKRs, your PEPs, your quadrants in Australia, they're still very much, you know, reserved for large, you know, management buyout transactions. And then you've got at the high risk end of the curve, you've got venture capital, which is taking lots of bets in companies that don't have any real revenues and they're very early stage. And that's a very high risk, high reward end of the market. Where we're trying to play, and we feel like we've still got a little bit of room in that market, is very much at that growth stage, where businesses have got real beating hearts, 10, 20, 50 million or more of revenue, and we're not taking a risk on whether the businesses will survive, more about getting the risks right around the growth potential of the businesses. And I feel like it's a natural place because you've got investors who see the IPO market where premiums are going up to get these investments before they IPO. I think everyone's hunting for that bit of a discount that you can get at a private stage of life.
Yeah, and in the private space, I was just going to say that definitely less volatility, not as irrational as what we've seen in the listed market. And to the point that David made, there's people, these private assets are being conservative in asking for injections of capital. But they've also come through a year where we can look at them and feel really comfortable that they've weathered the storm of COVID, right? So I think early on people thought there would be a lot of desperate asks in the market. There's been a much higher deal flow, but all focused on growth, not repair, right? So, you know, and it's great for us because we know we're only looking at quality, and it's just about, okay, what value can we add? And is this an asset for our portfolio?
And I'm curious, the private asset markets, obviously, it's been here in Australia for many years, but it just seems like it's coming to attention now. Is Australia sort of behind or ahead of the J curve in terms of demand for private assets? Is it a more developed market overseas? I'll ask you, Tony, just where Australia sits in that.
I think it's been under the radar. And I think the thing is, we've got great quality private assets. And one of the challenges that we experience is there's overseas equity firms, private equity firms also fishing in our pond here, right? And I think that's driven by the fact that there are more funds out there that people want to invest and diversify across listed and private. But I think it also represents the quality of what we've got here. I think it's been very strong in the US for a while, but when we've delved in that market, we didn't see the same level of quality that we see here in Australia, to be honest.
I might also add to that, Paul. I think one of the things to be very clear is in Australia, private assets have often meant property, infrastructure. And, maybe in Australia, there's a unique mining element to what we do, although I wouldn't necessarily think of that as a private asset market, more of a public assets. But where we're hunting, the theme that we're really focused on is businesses that are leveraging technology, disruption. And I think the thing, as an Australian investor, we're at a pretty unfortunate disadvantage. So if you look at the US market, if you're buying NASDAQ, and I'm sure you've done this with your clients, you're buying the US, it's 30 to 40% of those big US markets are represented by technology companies. You probably saw, or some of your clients might have seen, that in the AFR, they quoted UBS, which is talking about how in the ASX 300, it's gone from being 3% technology to just 8% technology. So overall, an investor in Australia, their starting point in life is they're underweight these higher growth businesses that are leveraging this disruptive power of technology. And so when you ask if if we're different to the rest of the world, absolutely. The starting point is one where, to get access to technology companies, I think it is forcing people to look more at the Australian private markets, where you've had venture capital, and just the nature of these businesses has taken an incredible acceleration over recent years.
That's a great segue, David, because I'm really keen to talk about some of the companies that you have in the fund. So maybe I'll start with you. So a couple of assets that you've had in the fund for a while now are Mable and Cams. Do you mind just spending a few minutes talking about both of those companies, David?
Yep, I'm going to, in the world of technology and Zoom meetings and sharing screens, let me just sort of provide a little bit of background on the company. So Mable's a marketplace business that provides services in the aged and disability sectors, in particular in home care. So Mable was created by two founders who saw the problem that people getting home care services didn't have the ability to choose the people who were coming to their house or to their loved one's home to provide the services. So in effect, they wanted to create an online marketplace where you as a consumer could go, look at the credentials, the experience, the languages, the location, and you could effectively build your own marketplace of carers, a bit like a dating app. So they started out focused on the aged care market, which, as we know, Australia has a aging population. So with the percentage of the population aged over 80, it's something like 19% of Australians, which is higher than anywhere else in the world, living in residential care. There's a clear agenda from the government, the Royal Commissions. Through COVID, we've seen a lot of conversations now that are pushing people to think, pushing the regulators to think a lot more about home care models. And then on the other side, you've got the disability sector. Once upon a time, the government provided funding directly to disability support organisations, but that model pivoted some years ago, and now they provide that funding directly to the people who are suffering from the disability, and so they can choose the services that they want to address for their loved ones. So the nice thing about Mable's business model is it's not only solving the needs of the NDIS, the aged care, it's also a better outcome for workers. So Mable, if you go to a traditional agency-led home care model, workers, they have schedules which are fixed by the agency. There's a lot of overheads which are incurred by the agency. So, the workers base ending up with something like maybe 50 to 60% of the net fee paid. And so you're getting a lower amount of value, a lower amount of control as a consumer of these services. What Mable does is it charges a 15% commission. And for that 15%, they do the screening, they help to manage the matching of the clients. They also provide insurance. So when a worker's in a loved one's home, there's an element of care and responsibility as well. So you've got this market which has been heading well and truly in Mable's direction. And then you've also got a business that every time you acquire a customer, especially in the case of someone with a disability, this is not a one-time job. They're building relationships between the clients and the workers that can have many years of lifetime value. So if you've got a child with autism and maybe you're helping support them when they're a teenager, and ultimately they're going to live independently and hopefully have a good, healthy, long life, you could end up having tens of years in that relationship. So how that manifests itself is you can see in this cohort analysis. So first of all, what this chart's showing is the monthly delivered care across the Mable platform. So if you go back to January 18, it was around about $1 million a month. And as each of the different colors in this chart represents the clients who signed up to the platform in that given month and how much money they spend on the platform. So if we come down here to sort of, February 19, you can see the clients that signed up in that month have continued to use the platform all the way through to sort of to September 20. So what they're building is sticky relationships, recurring revenue on the platform. And the really nice thing about that from a business model point of view is not just the value it creates for the clients and the workers, but also for us as a business, in the case of Mabel, you're effectively accumulating the growth in those clients on the platform. So you get this phenomenal growth rate that compounds at about 6% month over month. We've been involved with Mabel for around 4 years and the business has grown 50-fold. But every single month, it has averaged 6% month over month, which is more than 100% per annum. So we're now at a stage, and you can see down the bottom of these charts that the monthly cohorts keep getting bigger. So the business continues to accelerate at tremendous growth rates. And you'll see from the next slide here that we're building up this wonderful network effect between active clients and active workers. And now, you know, the business is doing about $12 million a month of delivered home care. And it is the largest home care provider by number of hours of any organisation in Australia. So, and they're addressing two markets that have got these incredibly strong tailwinds. So Mabel is a business that appeals to us, I guess, for a number of levels. One, we can see the industry transformation and the ability for this business to continue to grow and disrupt. We can also see that there's a long runway for this business to grow for many, many more years. You know, we think a market of at least $10 billion of services that Mabel can address. And if they were to get to, you know, they're at $150 odd million today, it is well within their reach to get to, say, a 10% share of that market, so $1 billion of delivered care over the next 3 to 5 years. And then ultimately, when we think about the exit and the realization, Paul, you know, this is a company that, you know, with such a long growth profile over the next few years, we're already starting to have the conversations and thoughts about when's the right time to IPO this business. With this tremendous growth rate and a business model that I think, you know, investors in an ASX sense would really understand, we're wrestling with not going too early where the growth rates are at these accelerated rates, but at the same time, we can see that there will be value at some point to raise a lot more capital for this company so it can really put its foot down on the industry and become, you know, the car sales for exactly what it does in Australia. And they're multi-billion-dollar companies.
David, how did you uncover the opportunity to invest in Mabel, just out of curiosity?
Yeah, so we, in sort of our previous experience of investing in private companies, were shareholders in a business called hipages, which is a marketplace that's just listed, that we've just been a part of the IPO. And hipages is a marketplace for tradies. So I sat on the board for that company for a few years. And in fact, one of the other directors, who happened to be an executive at News Corp, who was a co-investor in hipages, said to me, "We've just met this most wonderful business. Its revenues are tiny, but you know, we understand the problem that it's solving for people with disabilities and aged home care. We think it'd be worth having a look at." So we sort of founded at that very nascent stage as part of our Ellerston Ventures Fund. And one of the nice things was our colleagues here who cover the listed sector, we had a lot of expertise around what was happening in healthcare. And in particular, you'll remember there was a flurry of listings around aged care companies a few years back. So we were able to, even though it was very nascent at that point, you know, just a few $100,000 of turnover in a month, we could immediately see the marketplace effect. We could see the structure of the industry. And, you know, I think at the time it felt risky because it was so early stage, but it's been a phenomenal experience and management's executed really well.
Fantastic. And CAMS, David?
Yep. So CAMS, if I just jump forward, CAMS is very much in our wheelhouse in terms of, here's a company that was started, gosh, Joe Collins, the founders, in the more mature category, he's about 63, so he's not one of these young upstart entrepreneurs. Joe'd been around for sort of 20 or 30 years, having had a successful executive career. He pivoted into providing consulting and services to government agencies. So he was based in Adelaide. He took his consulting business and decided that the tools that he was building for his clients, and he was helping like local government agencies in managing their strategy, project management, and ultimately risks. He worked out the tools he was building, if he could develop those tools, retain the IP. So he cleverly created a development center in Sri Lanka, where he now has 200 developers at an incredibly modest cost compared to employing that many developers in Australia. But he built this great software platform from all of the engagement with his clients that's a cloud-based SaaS solution that he's now selling across a range of government clients in Australia, increasingly into commercial businesses as well. And he's also got a nice footprint in the UK and some international markets too. You know, like all of our portfolio companies, we do a lot of analysis on the trends of the business. And what this is trying to show is, again, that cohort analysis. So that recurring revenue, each year they're adding more clients and growing, you know, great trends in terms of the ACV or the annual contract value. So you can see the contract value getting bigger and bigger, having gone from $17,000 to $32,000. And you can just broadly see that the unit economics through the LTV, the lifetime value to the customer acquisition cost are improving. So CAMS is a business that when we first invested, which is a bit over a year ago, we invested on a $50 million valuation, and the company had around about $8 million of recurring revenue. As it had exited 2020, it's now at $15 million of recurring revenue. The business has had an exceptionally strong year, and despite COVID, given the nature of its clients, who were very sticky and you know, very high engagement on the platform, the business has continued to grow, get good recurring revenues. And so we actually, this is one of the companies, Paul, in the last quarterly update, we made a couple of decisions. One was that we'd revalue the business up because it had been 12 months and it had exceeded our expectations, was ahead of plans. So we raised the valuation to reflect that progress. But at the time of investing a year ago, we also had the option to put another $3 million into the business at the original deal price. So we also took the decision to put another $3 million into CAMS, which we've now completed in November, increasing our exposure, but also putting a little bit more cash on the company's balance sheet. But this is a business that, you know, we can see in 3-4 years' time, having doubled and doubled, you know, at least doubled again, so maybe a $50 million revenue company. And I think we'll have choices between corporate acquirers, and there's already some interested corporates who watch CAMS closely, as well as potentially having an ASX IPO. So this is a business that we think will have a few options as we move forward.
So David, what support did the team at Ellerston JAADE bring to the CAMS business?
So CAMS is, it's a similar playbook to something we've lived through before. So during our ventures fund, we invested in a Canberra-based software company called IntelliDocs. IntelliDocs was similar in that it had a set of founders, a good local software business. And when Joe from CAMS met Phil and Shelley from IntelliDocs, you know, they were really interested to know how we helped IntelliDocs and could we replicate it with CAMS. So a lot of it to be, it's really quite simple in many respects, but having seen how these businesses grow, a lot of it's about focusing on the sales disciplines, focusing on the approach to going into new markets and making sure you don't overcapitalize those entry strategies. And in the case of software companies, one of the really important things that we try to help them with is making sure they get the right channel partnerships, because you know, software is a product that you can sell anywhere around the world. So having a direct sales force sitting in every corner of the earth isn't the answer. It's about having e-commerce distribution channel partners. So maybe they're software integration firms, but it's about what are the tricks to driving the growth for the business. And equally for the CAMS founders, like the IntelliDocs founders, they see us sitting at the boardroom table and as shareholders in the business as being a value-added element that when they go to do the realization, there's a highly qualified investor sitting alongside them so that they can be, I guess, a lot more effective in terms of monetizing their efforts and the assets that they build.
And Dave, you mentioned this isn't just something that can be sold here in Australia. You had on the previous slide a listing of clients of CAMS.
Yep.
Is this opportunity within this business limited to the customer base of Australian companies, or is there the potentially that this could be taken overseas?
So where CAMS has got to, they've now got about 10% of their revenue out of the UK. In fact, the largest contract that they've done is a contract with the Royal Air Force in the UK. So again, that pedigree of being in government and government agencies, and the risk management solution, it's a contract worth almost $600,000 a year. So an incredibly meaningful contract. They're now going into the US and beginning to hire their first people in the US market. So we're trying to, you know, be very thoughtful. COVID's been a bit of a setback because we would have sent one of the bright young up and coming executives out of CAMS to the US to start it. In fact, the founder had been over in February just before the COVID wall came down, so to speak. But definitely the product translates very well. You know, risk management as a platform that manages risk, assigns responsibility. There's no specific regulatory impediment to them selling their piece of software in the US, UK, it's probably more language, so it's an English language product rather than, that's probably the only impediment to the markets that they can really serve.
So David, you've shown an incredible growth trajectory in the two businesses of Mabel and Cams. Tony, I'm going to hand over to you because one of the assets of the fund is SiteMinder. Now, you've got a deep experience in the travel industry, and from the outside looking in, the travel industry has been decimated during the COVID period. So what is that? So I'm keen to understand what SiteMinder is, and I'm keen to understand the impact of COVID on the business and the outlook for the company.
Absolutely. So I'll start by saying, yes, I think we all know how the travel industry has been impacted. We've had, in most cases, you've 95% of most OTAs top line was decimated just in a matter of days early on this year. But SiteMinder is, the way I like to describe it, it's a technology company that operates within the travel industry. It's a great platform, and it's a key enabler to around 34,000 hotel properties globally. It's the means by which essentially the way they describe the platform, it directs bookings, and it provides connectivity for hotels to distribute their inventory. And when I first met the team at SiteMinder and understood what used to happen pre a SiteMinder model, and in many cases it still happens, these hotels actually run their inventory and their bookings on spreadsheets with the support of many, many people. And in the digital world, where you've got all these online travel agents and booking sites, that's really difficult to do. It creates duplication. It needs a lot of manpower to manage and try and avoid double booking payments, et cetera, et cetera. So SiteMinder is a tool that these hotels need in the digital world. And as long as we've got OTAs and booking channels, and we've all gotten used to now not calling our hotel to book, we do it all online. You do need the ability to distribute your inventory through a platform like SiteMinder. And I think that's why they've got, they offer this in multiple geographies and multiple languages. And that's why I think they've got the number of hotels they've got attached to their platform. SiteMinder did see a reduction in the number of hotels connected as a result of COVID. They've seen a reduction of about 10%. Their core commercial model is subscription, so it's not transaction. So they didn't see, while they've seen a reduction in subscription properties, their business hasn't seen a reduction in revenue the way that we've seen online travel agents experience, airlines experience. They've basically stabilised their top line revenue, their top line subscription revenue, and haven't seen much of a reduction beyond where they saw their initial reduction. Where they've lost subscription, there's 10%, the 10% shift in subscription properties. They haven't gone to competition, right? They've pretty much just locked down, as we've seen globally. But in this period, while they've seen a reduction, their reduction in subscription properties has been a net reduction because they've been out in the market and they've been also buying in new customers, particularly in regional areas. So what I really liked about SiteMinder through this environment was, I think it shows the resilience of subscription. It shows the resilience of the product, because if you are open, the only way to get your inventory out there on these booking channels is using this platform. So it's not driven by the number of bookings you're getting. It's driven by the fact that you're open for business and you need to attract bookings if you're a hotel, right? So you could be 10, 20, 30% occupied. You need SiteMinder. So it just shows that while, yes, there has been an impact on top line, it's been around that 10%, and there's a sustainable position there as long as hotels are out there and they're open. And even though we've seen this progressive and rotating lockdown, there's constantly geographies that are open for business. And what we're seeing, particularly in Australia, is that significant increase in regional travel. We're going to see that more and more of that in Europe with the borders locked. People, just in New South Wales alone, every weekend is a long weekend for regional Australia, for regional New South Wales, right? So there is activity, and they're getting that activity. When COVID did hit, the agility of the business was very obvious. They jumped in, they pulled back on their employee base, reduced their cash burn. They sit at about $1 million of cash burn a month and are sitting at close to $45 million of cash on the balance sheet. So they're very well positioned. In that adjustment to headcount and cash burn, they didn't stop investment in areas that will help them grow during COVID and beyond COVID. So they're very well positioned to come out to sustain the impacts of COVID and then come out and grow their share outside of COVID. And that's because they've used this time to redirect effort on their go-to-market model. And as I said, go out and buy more properties or gain more properties in the regional areas. So really following travel trends and getting more inventory in regional areas. They've focused on a product that's going to bring more of the smaller end of the market online. One of the issues they've had in the past is it is hard for smaller operators to dedicate time to get onto the SiteMinder platform. So they've got a product that allows this to happen in an automated way. So smaller properties they don't have enough employees to dedicate to an onboarding exercise. So if you can automate that, you can quickly bring those guys on board, and they definitely need this product because they want to distribute their inventory. They've focused on a product to acquire more hotel chains at the top segment. And then they've also focused on their core product, which will allow their existing customers, as they come back and see a higher level of bookings, to switch on more of the SiteMinder products and therefore switch on more of the transactional revenue that SiteMinder doesn't have a lot of, but can actually gain from the captive 34,000 hotels they have today. So I think while it's reliant on the travel industry, it's not as impacted as all those other players in travel that are, whose revenues are driven by transactions. They are a must for their customers, and I think they're well positioned to weather the storm at the moment and come out of it acquiring a much higher market share once we see more activity globally.
Yeah, some preliminary observations are that for subscription revenues to only be down around 10% in this environment is rather remarkable. And secondly, I just can't envisage a hotel, for instance, using a spreadsheet to manage inventory. So I just imagine this is vital software for its users. I also think about the potential captured marketplace, the size of the marketplace. This isn't just Australia, this is the world. So I guess the question I'd ask is, SiteMinder, do they have many competitors in this area, or what's the size of SiteMinder? Or
they do. There is a number of competitors, but SiteMinder's at the top end, and they have multi-language and multi-jurisdictional exposure. The competitor base tends to be more focused on certain regions, which I think, from my perspective, I think it makes it easier for them to go in and take that share. It's just about focusing on that region and whether it's the language, the product, it's the team on the ground, so their go-to-market model. But I think they're well positioned to switch back on their existing customers, because, as I said, they've not gone to competitors, and to take on more of that market share. There's about they've got, as I said, about 34,000 properties, and there's about 1 million in the total addressable market.
Wow. And
so with their existing product and the new products they're bringing on and regional focus, there's a lot more that they can actually bring on.
Yeah, fascinating, Tony. Now, David, over to you. My understanding is that the fund has just acquired a new asset, a company called Prospector. I'm keen to learn a little bit more about Prospector and why the Ellerston JAADE team decided to invest.
Yeah, so Prospector's a business that we sort of just at the very early stages of COVID were introduced to, had a little bit of a get to know you. Well, COVID was sort of kicking along, and then we really ramped up the effort and completed the investment a week ago. And hopefully you'll see an AFR article sort of publicly announcing this investment in the next week. So Prospector is a business founded in North Sydney. So the founder, Ranjan, was a consultant working for KPMG on large SAP implementation. So when you think SAP, it's a multi-million-dollar solution used by very large organizations, complex organizations, and an ERP is the fundamental solution that you use to run your business, everything from accounting to human resources to inventory and supply chain management. So he was going in on these large SAP integrations and then consulting to clients, having set up a consultancy on his own, and consulting to them to how to make the data that they were using in their SAP platform more effective. And from that, a little bit like our friend Joe over at CAMS, he began to build tools, and he has a development center in India that he could then use with the next client and the next client. And fundamentally, the problem that he was trying to solve is that garbage in, garbage out. So if you're a large organization, you're running thousands of sites or tens of sites, and everyone's putting information into the system in a slightly different structural format, this unstructured data becomes a massive problem when you're trying to solve the information within your business. So they've developed a software platform, a rules-based system that effectively becomes like a data governance platform for managing these complex organizations. So what Prospector does is it helps businesses, these large organizations, to ingest their data. It also takes third-party information to add in any relevant standards or third-party information. And then it presents that data from a SAP, the vast majority of their clients are SAP users, in a really clean and effective way. So one of their clients, a US massive global company, Dow Chemicals, for them, the problem they were trying to solve was around spare parts. So when they were looking at their large SAP inventory management solution, they couldn't see if they had the spare part one time or 1,000 times because it was being coded differently through different locations. So for large organizations, and you see the names of some of their clients here, you'll recognize them as being very traditional, highly scaled industrial organizations. And in particular, around the part side of businesses is the area of massive expertise. So they're now part of the SAP network. SAP is a partnership program where they effectively help Prospector sell to clients because it actually helps the SAP clients get better value out of the SAP solutions. So in fact, if you're an SAP salesperson, this is quite neat, and you help Prospector get a sale, you earn credit and commissions on the sales of Prospector's platform. So you'll see here that having come from a pedigree of being a consultancy business and doing a bit of work with sort of smaller organizations, what's happened to the business in the last few years is they've grown the number of enterprise clients. The enterprise clients who are using, so the large organizations who are using Prospector, are typically paying at least $100,000 per annum per client. And so, you know, similarly, once you start using this platform, again, you're incredibly sticky. So the lifetime value and the recurring revenue attributes of this business become very, very attractive. So our analysis of the company was, one, we had to spend a lot of time with SAP to understand how much value they placed on what Prospector did. Were they going to replicate it? Did they need Prospector? So we've taken a lot of comfort from the detailed conversations we've had with SAP. We spoke to a lot of their clients to work out how long they would need to use the platform for. And what we see is those clients who are using it are often using, expanding the use case, so they use it in other areas of their business, which means there's a large opportunity not only for them to sell to new clients, but also to sell within their own existing client base. So it's a great story of a founder who's built a business over a long period of time. He's never had any external capital. The valuation on this company, it's around about 3 times revenue. So it's a $10 million revenue business. And so we're not investing at those 7 and 8 times multiples that you see in listed software companies, but at 3 times revenue, we've put $15 million to work. So 10 million's gone into the company to drive the growth. 5 million's gone to Ranjan, the founder, so he can take a little bit of risk off the table. And, you know, we end up with, you know, almost a bit over 35% of the company. So Anthony Klock, who's one of the investment directors at JAADE, he joins the board. Justin Diddams, who's one of our senior investment analysts, he actually found the opportunity through his own personal network. And so Justin stayed very close and been very engaged in the due diligence side of the process. He'll also work as the alternate director to sort of help to add value. And now we're sort of at the point as we really formulate the go forward plan with the company. how can we use our networks, our relationships, and the skills that we've learned, the experience we've learned from CAMS, from Intellidocs, and other software companies we've been involved in to really supercharge the sales network. And the most obvious opportunity for Prospector is here you've got a great founder who's pretty much been doing everything from head of sales to marketing to, chief product evangelist. So now we're sort of helping him in the first instance hire a CFO. Let's go out and there's 3 salespeople he's now hired within the first week who he had ready to go. So we want channel sales partners, we want US salespeople, and having a sales force on the ground. And we've got all the metrics around how they then should be managing that sales team. There's a real clear playbook in our view about taking this business and doubling the revenues over, at least the next couple of years. Sorry, Paul, you're muted there.
Thank you, David. Look, we're nearly out of time. So I'm really fascinated. I see 4 companies that you've got within the JAADE portfolio at the moment that appear to be high growth opportunities. So, I can only envisage if these companies were listed in public markets, the type of multiples that these companies would demand. So I guess the question I'm asking, and I hope you don't mind, and this is a question for both you, David, and you, Tony, so feel free to jump in, but how do you view the valuation of these assets that for what you're paying or how you're valuing them compared to, let's say, public markets?
Yeah, I'll just stop sharing the screen for a second. So I think I've been covering technology companies since 2000. So I was there as a technology analyst in a stockbroking firm, listing businesses in the dot-com boom. Markets come and go, and there are cycles and valuations. And I'm not going to tell you what's going to happen next. You and your clients can work that out, Paul. But the reality is we're in a really interesting time where interest rates are phenomenally low. So the number one thing that we're focused on is the sustainability of the growth rates of companies. So if we invest in businesses, the tide can come in and out on capital markets. We want to be able to know these businesses are going to grow anyway. So how do we then think about the valuations? So we've seen valuations on software companies expand tremendously from a listed company sense. So if anyone who's ever done a DCF analysis, if your cost of capital has now evaporated from, what might have been 15% for a technology company to very low single digits, when you do your long-term valuations, that means that you're getting tremendous value in the outer years into perpetuity because you're assuming these businesses are going to grow forever. We tend to take an approach of saying, that's all fine and good. We don't want to be revaluing our business every quarter because, the fund every quarter, because markets are going up and down. So we try to take a view that we look at our individual companies, we look at where market values are, we attribute a discount 30 to 50%. We then look out in 3 to 5 years' time, we do another valuation. What does it look like then in terms of, if we assume the business is going to meet our business plan? And then we also look at other metrics for how we value the business. So we try to triangulate the valuation and make sure that there's an adequate buffer between how we value it and how it might be valued in a transaction or in a listed company sense. There's no motivation for us to carry the assets at high value. So from how we manage the fund, it's all about the cash realization. So if we're investing in businesses with a view that we'll realize them over 3, 4, maybe 5 years, but we're not here to own assets for 10 years, but over a 3-4 year journey, if we grow companies, get towards those realization events, the proof will always be in the pudding when we get that cash realization event. The biggest mistake we can make is to be overvaluing assets too early in the journey, and then we can't actually make a sale without, having to write down the assets. So it's clear from our point of view that we want to be very conservative, build the value up. We don't want to also disadvantage investors who put money in. So to the extent that they're staying on plan, we want to continue to see value accrete, pretty much consistent with the growth rates of the company. But we want to make sure that when we go to realize it, we haven't created a hurdle for ourselves that we can't jump over.
And Tony, did you have anything to add on private public markets and valuation?
No, I think what David said about the proof in the pudding is the end realization, and that's our focus. And I think I said early on as well that, we while it's not a given, we do aim for a controlled outcome, and the way we make our investment selections is important to that, and how we support our investee companies is important to that. And it's that, and we're also not holders of these assets for 10 years. That's not the intention.
I could talk about this all day, but we are out of time. So David, Tony, you're both very busy people. Thank you. On behalf of GFM and our clients, firstly, thank you for your time today and explanations. Fascinating. But also on behalf of our clients that are investors, thank you for a great 12 months of results. We're really excited about our clients' investment in the fund and investing in private assets. All the best for the rest of the year. Only about a month to go, and all the very best of luck into 2021. Thank you.
Thanks.
Thank you.
Thanks, everyone.
Good on you.
Everyone.